Let me break down exactly what's driving this vacancy spike and why it matters for your underwriting. Overall market dynamics. Richmond's multifamily vacancy jumped from 5.2% in August to 6.4% in November. That's a 23% increase in occupancy pressure in just one quarter. But story gets more interesting when you dig into the submarkets. Class A properties are leading the decline. New deliveries in Scott's Addition added 8.4 units to the market in the last 6 months, while Manchester saw 623 units come online. The problem? Absorption isn't keeping pace. Scott's Addition is running 9.2% vacancy on newer assets, and Manchester is at 8.7%. Class B assets are showing more resilience, but with warning signs. Vacancy is up from 4.8 to 5.9%, which seems manageable until you realize that's where the bulk of investor demand has been concentrated. When Class B starts softening, that's your institutional buyer base rethinking their allocation. Class C remains the tightest at 4.1% vacancy, but here's the concerning part. Collections are deteriorating. Property managers I talked to are seeing 30-day delinquencies creep up from 2.3% to 3.8%. That's not vacancy yet, but it's the leading indicator. Here's a math that's reshaping your buyer behavior. If your debt costs 6.7, you need 130 basis points above spread for acceptable DSCR coverage. You're looking at a minimum of 8% cap rates just to hit basic return thresholds. But most institutional buyers would want 50 to 200 basis points over the spread to cover the cost of capital. Translation: 6.25% cap rates that trade freely 6 months ago are mathematically impossible. Buyers who are still competitive at 7.4% caps, depending on asset quality and submarket dynamics.